Hello friends, before I make you a boatload of money, I would like to say a prayer to the market gods. Jerome Powell and Donald Trump, if you could please rip the market 17% from here, much would be appreciated. The bears have started to become vocal again, and we've had 18 months of peace, and we need to shut them up.
Just a minute, Bear. Hey, shut up! No, you shut up!
No, you shut up!
Hey, will you shut up?
No.
Just shut up!
Oh, and don't forget about those tax cuts, Trump. Let's roll the tape. Welcome, everybody, to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. US stocks were mixed on Monday as Tesla shares continued the momentum, leading the charge higher, but we saw broad-based gains after last week's overhang. The stock market really trying to kick this week off by getting out of last week's funk. And last week, we really just saw the market pull back on signs of a robust economy combined with comments from Federal Reserve Chair Jerome Powell, which prompted investors to downsize rate cut expectations. The market pulled back as a result, and today we just saw a bit of a bounce back led by Tesla, Apple, Google, Meta, and some cyclical names like real estate as well as energy. We saw underperformance in Nvidia, but the broader semiconductor market was very, very strong. We saw very much the same here in software, except Intuit, Uber Technologies, and CRM were down. So maybe we're seeing a bit of a broadening out into the smaller software names, and then infrastructure was very lackluster compared to the entire market. We saw the Dow Jones actually fell today 0.21%, but the S&P 500 gained, the Nasdaq 100 gained as well, and that's on the back of a flat Microsoft as well as a red Nvidia. So it just goes to show the broadening out we're seeing, and that was the story of today. We saw broad-based gains. Every sector was strong. Every sector was green today, except for industrials, and we also saw underperformance in healthcare and industrials. These two sectors are going to get hit the most from a Trump administration because Trump wants cheaper healthcare, and also the Department of Government Efficiency could be affecting the industrial trade because a ton of military money goes into those stocks, and maybe we're not going to see quite as much. So I think for the next 3 to 4 months, maybe up until inauguration, I think these two sectors are going to underperform the broader market. That being said, the S&P 500 gained up 0.38% today, with XLF and XLK technology and financials underperforming the SPY. Those that outperformed the SPY were real estate, materials, utilities, staples, the discretionary space, and then we actually see XLC up 1% on the back of Google and Meta, and then XLE, the energy sector, up 1.43%, but there was some geopolitical concerns going on that we're going to talk about later on in the video. And then looking at the broader market, we saw gains across the board. It really just wasn't everything rally today. We saw small caps, mid caps, large caps, value core, and growth all gain, with mid cap core being the best performing factor segment up 0.64%. But really, no matter where you were positioned in equities today, we saw a bounce coming off last week's lows, and that bounce was led by Tesla. Tesla up 5%, at its highs up nearly 8%, and that's on the back of the Trump team looking to ease rules for self-driving vehicles. Again, Tesla is going to be the major benefactor of that. A lot of these EV rules really just benefiting Tesla, and Tesla's going to be the winner. The stock's probably going to $400 in the next 3 to 4 months, and it was at $270 just a couple of weeks ago. Kind of insane when you look at that. Nvidia, the leader in the market this year, which has accounted for 20% of the S&P 500's gain, was down 1.5%. It really weighed on the market today. That was on the back of some reports on Blackwell heating issues. And then we also saw gains in gold up 1.86% or thereabouts. And this was because we saw some escalation in the Ukraine and Russia war. The Biden administration authorized Ukraine to use US-made long-range missiles to strike deep into Russia. And when there's geopolitical tension, gold is going to soar. We were at 2,600, and gold tends to outperform when there's geopolitical tension. But what also helped the overall market today was some data we got. Looking at the Home Builder Confidence Index, it reported a 46 handle. The median forecast was 42, and the Trump victory offered a modest boost to home builder confidence. Now, the NAHB, this index right here printed at 46. Now do take into consideration that any reading under 50 still indicates rather poor conditions, but we did see a beat, and that's exactly what you can ask for. And that's why we saw mild outperformance in some of the real estate names. And this was also on the back of yields easing today, as well as an easing dollar. And all in all, when we look at the broad market, right, everything still looks largely intact. The 20-day, 50-day, medium term, longer term trends still look very intact. We actually saw a massive improvement in the 5-day as well, although the 5-day moving average is very, very noisy. All things considered, the percentage of stocks above the individual moving average looks very robust. We are still in a bull market, and you don't really want to fight this trend. You just want to buy aggressively on dips that we do get, because we will go higher into the end of the year. But let's hop on the charts. And looking at the broad market, guys, we saw a very positive momentum in equities. The S&P 500 and Nasdaq large caps gained. They were the outperformers. The RSP and mid caps were up 0.4, 0.19%. This compares to the Nasdaq 100, which was up 0.7%. So a very bullish day across the board. And what really supported the move in equities today was actually yields. Yields did come down ever so slightly. The dollar also fell. That supports large cap stocks with international diversified revenues, right? And as a result, equities gained on the back of that. So just a cheaper cost of capital in aggregate means that stock looks slightly more attractive. But that being said, with the weaker dollar came stronger commodities. And again, this was on the back of some geopolitical news, some of the stuff in Ukraine with Joe Biden. And we saw gold up 1.9%, silver up 3%, crude as well up 3%. And when you have geopolitical tension, generally speaking, gold rallies. And I think we're actually going to see crude rally as well, because there was some, I saw some headlines in Norway, some of their oil lines getting disrupted. We'll see how that turns out. But yeah, being said, let's look at the overall market, the S&P 500, guys, and the gamma flip zone holding in there. The S&P 500 didn't see much trading below the gamma flip, but a lot left to be desired here in today's move. We saw selling here at the top. If we actually just go to the 1-day move to see what happened today, we saw a huge move here in early morning trade from the gamma flip, right? And then we actually saw from the highs, lower lows. However, we actually never got to the day's lows, and net we were up 0.4% for the day. We actually saw quite a bit of buying here at this level, the 58.84. This is looking like a very strong level right now. And I think if we hold this level into the rest of the week, we should see continued upward momentum in the S&P 500. That being said, some vicious sell side from the top here, but a lot of buying from the bottom. A very mixed day of trade, all things considered. However, when we look at the year-to-date chart, things looking very, very strong. And I think what the bulls really need to do right now is actually clear this high. If we can go ahead and have a close above Friday's high, clear that, I think things will look up for the S&P 500. But as long as we're below that high, I think the bears are going to continue to sell like they did today. They're going to sell that high. And if we break below the gamma flip, that means we're going to move lower. But as long as we consolidate here, I also think that's largely constructive for equities, especially as we go into the back half of November and December past Thanksgiving. Then we should see more momentum to the upside. So the longer we consolidate here, it's better for the bulls as long as we're in positive gamma. But if we do break negative gamma, the next zone is 57.85. That's still largely constructive, and we're still well above the move we saw here after the election. This was the election gap up, still largely above it. And even if we do pull back all the way to the 57.88 level to the put support, we would still be where we were at the start of the election. And that would just represent a great buying opportunity relative to the all-time high set at the 6,000 level. Looking at the RTY, the Russell 2000, now we did see the gamma flip move lower, the core resistance move lower, and a lot of selling off the highs for the IWM. If we actually go to the daily chart, very similar to the S&P 500, we saw a huge move up on the open and then lower lows, lower highs. However, we actually nearly tipped the lows of the day. We did see a little bit of reprieve here to the end of the day, but the RTY, the IWM finishing up 0.2% for the day. So a little bit of more volatile price action. We're still at the put support. This is looking like a sign like it's going to hold. However, guys, if we actually break this put support, the put support moves lower and that opens up the 2,200 area and below. We don't really want to see that. So the bulls need to step in right here, right now for the Russell 2000. And then looking at the Nasdaq 100, its gamma chart, very similar to the S&P 500. However, we're at a very key level. We did get into positive gamma. We stayed in negative gamma for most of the day. And what's very, very concerning is that we got into positive gamma, but the bears brought us right back down into this negative gamma area, which means there's definitely some conviction selling at these highs. So what we want to see tomorrow, like the S&P 500, is we want to see a move above the gamma flip and a close. That's what we want to see. If we can get a move in the Nasdaq 100 above the gamma flip, right, and then a close above yesterday's high for the S&P 500, that would be very, very good for equities, but we'll see how it plays out. That being said, I did say in last week's video, on Friday's video, the weekend video, that what we are going to see in the Nasdaq 100 is a move up to the gamma flip, right? And then from there, we're going to have a move either above it or below it. And that's exactly where we are right now. So into Tuesday, into Wednesday, as well as Nvidia's earnings, that's really going to determine what comes next. Are we going to move higher from here, or are we going to take the move back to the put support? Either way, tomorrow is going to tell us a lot, and Wednesday is going to tell us everything we need to know. Looking at the RSP, constructive. I like what I'm seeing right here. I think this is a great area of support to buy if you're bullish. However, breaking below this, we can actually see the closing of this gap, and that's what we're seeing with the S&P 500 right as well. We break the gamma flip, we're going to close that gap. With the Nasdaq 100, we nearly actually close that gap, and with the RSP, if we break the zone, we could actually close that gap. That being said, very constructive price action, but there were bears today, there were bulls today. It's really hard to determine what the market's trying to price in. I think as we get more certainty with Trump's cabinet picks, and once we get past Nvidia's earnings, we should see further upside in this market, but we're just in a bit of a churn zone at the moment. That being said, constructive price action for equities. Is it a dead cat bounce? I'm not going to go out and say that just yet, but I will say that a lot of the price action we saw wasn't really like a lot of bulls convicting, because we didn't actually retake like Friday's highs in the RSP as well as the S&P 500, but still in negative gamma in the Nasdaq 100. So what we really want to see today is follow through. Otherwise, I think we could see more churn ahead for markets. So guys, we're still in this November time period where we see a lot of digestion pretty much in the seasonals. We really see November take off. November seasonality chart looks something like this, right? This middle part here, we get a lot of churn. That's where we are in right now. And that sort of ends around the 20th, 21st, 22nd. That's when we'll make the next move higher. So do expect churn. If the markets do want to go higher, we have to retake positive gamma and break some of the key levels in the Nasdaq 100, the RSP, the S&P 500. And what I really want to see from small caps, the RTY, is a move back to the gamma flip. If we can do that, Bob's your uncle. We're going to go higher. If not, expect more continuous churn for the markets as a whole into the end of November. And with the charts out of the way, let's talk about valuation. And according to Morningstar, they see the S&P 500 as 4.3% overvalued. At one point, we were very close to 7% overvalued. That was at the peak after the election. For most of 2024, guys, we've actually been very overvalued. And that is overvalued based on these fundamentals right here. The consensus expects 13% growth in 2025. That's S&P 500 earnings growth. And then 11% is Goldman Sachs portfolio strategy. So the market has really brought forward a lot of 2025's demand by being overvalued more than 4.3%. And that has left us in a state of neutral sentiment. The market sort of realizing in the last week that, hey, things are getting a bit frothy. Earnings growth may actually come down further. And that is why neutral sentiment is driving the market. People are not necessarily bearish, but those that were excessively bullish are starting to look at things again and saying, hey, I think things are getting a bit frothy. A pullback would be welcomed, but they might not get it within the next couple of months, because if we actually look at S&P 500 performance, where the market was up 20% or more by the end of October, what we normally see in the month of November, average returns 2.6% in November, 3% in December, and the last 2 months normally returns about 5%. We've actually roughly seen about that return so far in November, at least in the S&P 500. So we'll see what the December returns look like. But generally speaking, when we get a bullish year into October, it's preceded by a bullish November and December. And the truth of the matter is, it has been a broad-based rally. Sector year-to-date total return greater than 25%. We're sitting at 6, right? The last time we saw this type of broad-based outperformance was 2021 in the everything bubble. And then again here in 1998 and 1995. So very solid fundamentals here in 2024. And again, guys, when we see this type of outperformance, it normally leads us into more gains into the end of the year. And the market just has a ton of tailwinds behind it. Seasonality, earnings, market breadth. And what we're also seeing is that private equity and venture capitalists and venture capital firms have a huge amount of dry powder. We actually did see this tick down from 2023, meaning that PE firms and VC firms have been putting money to work, but they still have an excessive amount of dry powder. And if we are to see the easing cycle we're expecting into 2025, M&A, animal spirits, this will be a huge driver of growth in 2025 and beyond. But those are all the favorable tailwinds for equities. There are risks we do have to be aware of. And one of them is simply Trump. This is just a message from Goldman Sachs. We're going to read. They say, we expect the second Trump administration to bring higher China and auto tariffs, much lower immigration, some fresh tax cuts, and regulatory easing. If so, the US economy should grow 2.5% in 2025, outperforming consensus expectations and other developed market economies for the third year in a row. The biggest risk is a large across-the-board tariff, which could likely hit growth hard. And diving into more specifics, right? This is Goldman's base case for the Trump administration. They see new tariffs on China up to 60%, average to a 20 percentage point increase to the effective tariff rate, mostly reflecting new tariffs on lists 1 to 3 items from the 2018 to 2019 trade war. Tariffs on the EU, a 22.5 percentage point increase in the effective tariff rate on autos. They're going to put tariffs on Mexico, and overall, you should see a 3.4 percentage increase in the effective tariff rate for US imports. That is definitely going to affect inflation. Net immigration slows to 750,000 a year in response to increased funding and tighter enforcement. And then looking at fiscal, they see a full extension of the expiring tax cuts in early 2025. That's the TCJA. They expand the SALT deduction. They're going to exclude overtime from the income tax rate as well as tips. They're going to lower the corporate tax rate for domestic manufacturers to 15%. This is what's going to boost the stock market a ton. If the Trump administration does that, the current tax rate is 21%. That is going to see a huge boost to earnings and overall margins. Trump also plans to reinstate a more generous corporate tax incentives, 100% bonus depreciation, R&D expensing, and interest deductibility for $60 billion a year. That's the cost, and allow enhanced ACA subsidies to expire, as well as limitations on green subsidies. Very interesting. Looking at regulation, antitrust enforcement eased somewhat through major pending tech sector cases proceed, meaning that maybe Google and stuff like that, what's happening with Meta, Amazon, they may be easier on those companies. Easy approval for energy projects, expanding LNG exports, and reversing restrictions on greenhouse gas emissions. That's really good for the energy sector, utilities, tech sector, the material sector as well. And the near-term easing for regulatory burden on consumer finance companies, medium-term easing of capital and liquidity requirements. And then looking at the risk case, pretty much what they see is more broad-based tariffs, which could revoke normal trade relations, and then selective deportation of immigrants and criminals, which could see 1.2 million individuals deported from America, and forced deportation along the lines of Eisenhower model that removes 2.1 million individuals. And this will tangibly increase prices because a lot of cheap labor is dependent on these individuals who are in the country undocumented. It has its pros, it has its cons. These are the effects of the Trump administration. We're going to see how they implement this, and it's going to be a very bumpy year. I am bullish, but guys, it's going to be a very bumpy year, especially with the tariffs that Trump is planning to implement. We are going to get a trade war 2.0. It's going to happen. It's just how we navigate the situation effectively. And diving into the macro, we're going to take a huge overview of the entire US economy, what looks good, what looks bad, and where do we stand right now. And this is just the highest frequency and highest quality indicators for US economic health. Now guys, looking at daily data, restaurant bookings very strong, air travel data is strong, daily debit card data is solid. All in all is telling us that consumers still hanging in there. Looking at weekly data, the Fed's GDP now at 2.5%. The weekly GDP index at 1.8%, not that great if you ask me. But then we look at retail sales, very strong. We got the data last week. Jobless claims is solid. Hotel occupancy, strong. Looking at bank lending to firms, essentially banking credit, that's going sideways. Not great, not bad. Hopefully, if yields do come down, we should see that increase quite significantly. And then we actually see bankruptcy filings trending lower. You love to see that. Credit and debit card data is solid. Gasoline demand is solid. Broadway show attendance is strong. Box office weekly grosses very strong. S&P 500 forward margins at record highs, sitting at 13.5%. Business formations is rebounding, and the ASA temperature work staffing index is actually trending sideways. So not strong, but not in the dumps either. And pretty much what this data is telling us is that the US economy is sitting on very, very strong footing, but there is a major risk to having such solid economic data, and that's we could see a resurgence in inflation. Now, these are two charts right here looking at 1974 to 1982, the massive inflation spike, deceleration, and then re-acceleration of inflation. This is the inflation of the 70s and where we stand right now. Now, I do want to preface this that yes, inflation is ticking up, but this chart is very, very deceptive because if you look at 1974, this is their axis. If you look at the current CPI, this is our axis. Completely different axes, right? Which is very deceptive when you put it like this, because inflation started to re-accelerate here in the 70s when we weren't even below the 5% mark. Whereas right now in 2023, if you actually look at it going all the way back, we're at 2.6 and 2.7% in CPI. So that's a stark difference when you look at it, all things considered. So if this chart was on the same axis, this green line right here, which is current CPI, would actually look something more like this, right? Because that's the 2% marker right there. So that's what the chart would actually look like against this blue chart right here. So very deceptive. Nonetheless, we are starting to see a slight uptick here in inflation. And based on the stronger economic growth we're seeing, as well as Trump's policies, we need to keep a keen eye on inflation. But to be honest, I don't really like CPI that much. I much prefer PCE. And we have to see what that looks like over the course of the next 12 months. If we do start to see a tangible resurgence in inflation, that is going to be terrible for markets because stocks do not do well in a hyperinflationary environment. Nonetheless, inflation is still at 2.6% and things are looking rather robust. And if we do see a slight uptick in inflation, as long as it's supported by stronger economic data, like we are seeing right now, it's no real cause for concern. Looking at the rest of the week in earnings, guys, tomorrow before the open, the big one is obviously going to be Walmart and Lowe's. That's about it. For Tuesday, there's a couple of other names here. For example, stuff like Medtronic. If you're in a small cap quality ETF, that's a big holding in a lot of small cap quality ETFs. And we have a couple of Chinese names, but the real big day is going to be here Wednesday. We have Nvidia. They're reporting after the close. All eyes on Nvidia. But after the close as well, we have Snowflake, Palo Alto. So all of the AI names. And then before the open, we have Target, TJ Maxx, Wix, Neo as well. So a pretty big day of earnings here on Wednesday. And then looking at data for the rest of the week, guys, tomorrow we actually kick off some very solid data. We have building permits and housing starts. That's really going to tell us where we stand with US housing data. And that's going to be really key to see what has happened in the last month, especially as rates have gone up significantly. We've seen a 70 to 80 basis point increase in yield, specifically the 10-year, and we need to see if it's going to start impacting demand. Now, building permits, the forecast is for 1.49 million and month over month 4.5% increase. Housing starts, we're looking for 1.39 million and a 2.5% month over month increase. Those are the major market movers for Tuesday. Then Wednesday, we don't really have anything in terms of earnings. And then we'll cover Thursday and Friday later on in the week. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button and leave a comment for the algorithm. Cheers.